he'll introduce our speaker.
I'm Rob Ford, I'm the student president and CEO. I'll just give a quick introduction for Jason. So Jason's the managing director at Arsenal. He spent the last 15 years founding, building, and funding early stage ventures. He's a frequent speaker on the topic of technology commercialization in the intersection of government and commercial markets. Jason's been involved with founding exits of numerous technology companies. He's the founder of Muse Ventures and IT Angel. Jason was also previously a manager at Arthur Andersen's Silicon Valley office, where he began his career in Washington, D.C. He graduated from Georgetown University, went on to pursue his MBA at Harvard, where he graduated with the highest distinction. His family is originally from Montreal, Canada. He's the first American-born person in his family. He was playing sports of all kinds, squeezing in a tough workout on the road, and getting outdoors with his family. I'd also like to mention that Jason and Arsenal have actively recruited people for his firm out of Crummer. So if you're interested in pursuing that out, you've got a seat here. He's definitely a great person to be in touch with. With that, I'll hand it over to Jason.
I'll refer any of those to Casey. Great. Well, thanks so much. First thing I wanted to do is ask you guys to do me a favor. So you pull out your phone and you're on Twitter and you want to follow us. Our firm, Twitter, me, but gosh, you'll be here later, and Casey Silver are all on there. So follow us if you can on Twitter. And two things, I'll make it up to you. The most insightful comment, I'll track you down tonight and get something good to you. And if I missed anything in this presentation, tweet something about what I missed in this, and I'll get you something as well. So I'll track you down, I'll figure out how to do it. So I'm going to walk through this, and I'll talk a little bit about the format, but I'm going to give a brief overview of what our firm is so you have a little bit of context on who we are, what we do. Then I'm going to spend a little bit of time with Casey here, sort of contrasting what we see, the things that are bad pitches and good pitches. I'll give a little overview at the front end, and then we'll literally sort of go through a mock set of slides and give you a feel for what makes sense in these pitches and what doesn't. So a little bit about Arsenal Venture Partners. We're focused on the intersection of government, large organizations, and emerging technology companies. So we don't invest in just sort of anything that comes across the road. We invest in things where we think we can add some sustainable long-term value that differentiates us from other people who write capital. We invest sort of early to mid-stage, meaning we'll write a $200,000 check up to sort of a $5 million check. We've got people all over the U.S. And our strategy really stems from the fact that we manage a series of funds for some very, very large organizations. So DOD, Department of Energy, Treasury, as well as the state of Florida. We've been together for a long time and have a team that's sort of set up to operate in this way. So not only do we invest, but we spend a lot of time investing in building our companies with resources and connectivity. So what do we invest in? Companies that we think can grow at a really, really attractive rate. And so that gets a little bit to the team, gets a little bit to the type of company it is. We're comfortable with execution risk in companies, and we're normally the first institutional capital, meaning that you may have had angel funding before, you may have had no funding before. We're usually the first people to write a check from an institution requiring maybe a little bit more structure, a little bit more setup around how you think about your board working, how you think about long-term planning and growing the company. We have a few areas of conviction which I'll share with you guys, and can you back up 1 second? Sorry, Case. And a lot of investing is having really, really quality syndicates alongside you. So we rarely invest in deals by ourselves. We almost always have folks around the table with us. So ones that are popular today, Andreessen Horowitz, Google, Data Collective, Winklevoss, but also guys like GE Capital and GM. By the way, the Winklevoss guys, go to their website, they have an unbelievable portfolio of companies. So everybody jokes about them. Go look at their companies, it's sick. They have a sick set of portfolio companies that are doing really well. And then just traditional guys, right, like DFJ and Menlo. And we've invested with Benchmark and Sequoia and all those guys. But having a good syndicate of folks around the table is really, really important, because building a really long-term sustainable company with a great organization and a great culture is hard to do. Next slide. We have a few areas that we sort of have been investing in lately, and you'll notice that the difference here, I won't go through this in detail, is that we really focus on having some type of strategic sponsor for that. So when we invest in this space, and I'll use commerce and logistics as an example, we're investing in opportunities where we think we can leverage some government elements, and that includes everything from DoD to Postal Service to some Fortune 500 resources or knowledge that we have that can help that company grow faster and get an edge on its competitors. And we have that across the board here. So that's a little bit about us. We really try to build this unique network. And while it benefits us because it allows us to get into deals and see opportunities other firms won't normally have, the people that it really benefits the most are our portfolio companies and the management team in our portfolio companies. Because what it allows us to do is, if you're struggling with how to expand your logistics footprint, and we can put you in touch with the team that works the digital strategy with Postmaster General, or we can put you in touch with the senior developers at Apple who are working on next generation imaging. That problem, and you're an imaging company, that helps you get a leg up on your competitors and really understand how you should be spending capital, how you should be building your team, and what your exit's going to be like long term. And so that's the reason we do it, because we think it gives us an unfair advantage in our ventures and lets the founders and entrepreneurs be more successful. Next slide. So a little bit about me. These are my current portfolio companies in here. So mostly high-tech stuff, some local companies, a lot in California. So Boston, California, Florida, California, Colorado, Boston. So you can see it's pretty typical. My portfolio and the portfolio of the firm looks about like the portfolio of venture in the U.S. in general, meaning it's heavily weighted to California and Boston, but there are also some companies, one sprinkled in Indiana, one in Colorado. I have a few here in Florida, so they're all over the place. But the thing that is not different about any of these companies is we've invested in all of them because we think they have an unfair advantage of growing very, very quickly with a limited amount of capital. And that's what all these things are about. On my background, I've been doing this for a long time now. I look really old. I'm not quite as old as I look, but I've been doing this for about 20 years. And I've been involved in a bunch of early stage startups. So ones that went great, went public, it was wonderful, to ones where we burned through $40, $50 million and turned that into about nothing. So I've had ups and downs in my career with my companies, and that's sort of the way things work. So we're going to talk a little bit about what we think are good pitches and what we think are bad pitches. This is heavily opinionated. So this is my opinion, and I suspect, and probably Casey and these guys can relate, I'm not sure this is unanimously held even among all of our partners, right? So certain people like certain different things. So I'm going to start with a couple sort of top line things that everybody should think about that are just absolutely universal. And then we'll give you some examples of good slides and bad slides. So we tell people this all the time. I tell this to people, first impressions is your first impression. You can dig yourself out of a hole. That's possible to dig yourself out of a hole. But we'll always remember that you were in a hole when you showed up. So make sure that when you're stepping up to the plate and having, hey, can I meet you for a cup of coffee, or can I do this first pitch, or I want to meet with you, we will always remember you from that first meeting. And for better or for worse, we can't forget it, right? That's just the way it works. So make sure you've really, really thought about that first meeting. And by the way, it never hurts to say, hey, I'd really love to meet with you, and someone says, hey, let's meet next week. And if you don't have your you-know-what together next week, just push the meeting off. It's okay. We'll fill our calendar. Don't worry about it. But push that meeting off. The second item is understanding your audience. I can't tell you how many times we have people come in who present to us and have no idea what we invest in, have no idea about our backgrounds. By the way, all our backgrounds are on the web, right, and on LinkedIn. So you could find out too much about us in all likelihood. really, really know your audience. So, know what the firm's about, know what deals they've done, know what deals they've done that have turned into nothing, and know what deals they've done that have gone public or they've sold for really, really big multiples. Knowing who you're presenting to is really, really important. The venture market is not very transparent, meaning you have no idea where I am in the life cycle of my fund. So you don't know if I'm looking at doing 20 deals out of this fund and I've done 18, or I'm looking at doing 50 deals and I've done 2. You're never going to figure that out, so don't worry about that part. But know the people in the firm and what they're interested in and what deals they're involved in and all those other types of things. And that type of information is more available than it's ever been in the history of our industry. Because you can go on my LinkedIn site and you can figure out what deals I'm on and who I'm connected with and all those other types of things. The third item here is know what pitch you're giving. So if you're going to come in and give the 2-hour pitch on the entire business and what your financials look like and whatever, great. Do a 50-page deck, go into all the detail you want. If you've got a 30-minute slot, you got to choose really carefully about what you put in that deck. 30 minutes, because those 30 minutes will be up before you know it. And if you get through your first 2 slides in 30 minutes, and we're meeting with 10 companies that day, that's it. That's your first impression. That's what you got. So really understand what you're doing. The other element here, and this is a confusion that everybody always has, is, well, should I prep something that I can leave behind that you can just read, right? That depends, right? If you think that you have a 30-page deck that I should read beforehand, or you are just getting 30 minutes with me, give me a 10-page deck that you can run through that can help me understand the business. And if I'm interested, believe me, I'll ask you for more information. And if we're really interested, we will ask you for more information than you ever wanted to give us. And we'll make you think about it hard. Fourth item, this should be self-explanatory, although it isn't. You got to know the material. So if you present financials to me, believe me, we're going to ask you lots of questions. Okay, in 2016, how many customers is that, right? What does your headcount look like to generate that amount of revenue? How many salespeople do you have if you're going to scale like that? All those types of questions. Can't imagine how many times someone has a revenue number up and they don't know either how many customers that is or how many salespeople they have selling into customers. So before you do this pitch, make sure you know all of that off by heart. So don't say you got to look it up on the deck, don't whatever. You should know all those types of basic things by heart. And the last item here is practice. We know not every person that's pitching us, in fact, most people aren't great at giving pitches. It's not really a natural skill for most people. It's actually often not a natural skill for really, really good entrepreneurs or really good company builders. But just practice a little bit. So know how you flow from one slide to the next. Have someone ask you some hard questions. If you're a person that is prone to talk too quickly, yours truly sometimes included, practice taking breaths, deep breaths in between. If you have any questions, is that clear? Is there any more detail I can give you on that? Little phrases that can perhaps help you slow down the pitch. So these are things you just got to do every time you present. And if you actually do these things, all the little details in the back you can make up for. Because most of the time, pitching to an institutional investor is a really unnatural act, right? It's not really talking about your business the way you talk with customers about your business. It's not really talking about the business the way you talk with people you're trying to recruit into your company or you're trying to hire. It's a really sort of unusual act, right? You're coming in, and my job is to pick companies that I really like, and then write them a check, with the idea that I'm going to write them another check sometime down the road again. And so it's unnatural. But if you can do this well, you can pitch customers well. And you can pitch prospective employees well, which, by the way, is probably the most important thing you're ever going to do as a public company. Next slide. So I'm going to preface everything with the fact that we tried to put together examples of a good slide and a bad slide for each of these areas. So this isn't inclusive of everything you should have in a pitch, but this is pretty close, right? introduction, here's what the team does, here's the product, here's the market, so we're going to sell it, competitors, financials. And so we put together sort of a couple companies that are completely fictitious. I might say completely fictitious. I didn't use any of the pitches I got this week for this. And we'll go through sort of what's good about them and what's bad about them.
So, yes, we'll start with the bad. Any idea why this might be a bad slide? Any comments as you start with?
The font size?
Font size, plus the name, Sour Hippo.
Sour Hippo.
So this is a bad intro slide. This is an example of bad intro slide.
That's an awesome intro.
So this slide is kind of getting to who you are. Any idea why this might be a bad slide? Totally convoluted, way too many words. You're not going to stand up there and read it. And if we're looking at it, it's like, I don't want to read that thing. There's just way too many words on it.
Right. And by the way, so the basic assumption, right, when you're pitching, particularly institutional guys, is we're really lazy. We all have ADD. Some of us worse than others. It's just not. It's not a thoughtful, going to sit around and wait to get the info as we read slides. It's just, that's not the world. And it's not just us. It's almost every person that's in this business, unfortunately. Go to the next slide. So, really easy slide to read, right? It just tells you what the company does, who's in it, and why we're sitting in front of you. That's it. And the KISS principle is true in all these pitches as much as you possibly can, which is, just feed us bits of information that help us really understand what you're doing, why you're here, and why it's important to us and everyone else around us. My favorite slide, I lost Carrie.
Oh, we just lost Carrie for this slide.
Carrie. Carrie. Just come back in for 1 second. We just wanted to let you guys just sit on that. Made the slide.
Oh, we have nothing like announcing my departure. I did, I'm so excited. Oh, and what am I?
Former professional volleyball player.
All right, so the reason why this is a bad slide, it has nothing to do with the people that are on it. It's because the backgrounds have nothing to do with the company that they're trying to build, which Jason mentioned is an e-calendaring kind of email integration company. So you would think that they would have relevant backgrounds for that. So on the good slide, it said X Microsoft, X Salesforce.
So go to the,
That
so go
catches
to the
you.
next one. So
None of that is on.
good slide. You don't have to put every single person on your team on the slide. So we see this so many times where we have a team of 6 people come in. 2 of them have relevant experience and have done stuff before. The rest of the team members are on there, and I've got 6 people across the slide, and it doesn't help me. And I've got half of the people have no relevant experience in the business or any of those types of things. So generally speaking, this is the most important slide in our team that makes us think about whether or not we want to pay attention for the next 20 minutes of your pitch. And it's who are we talking with and what relevant experience do they have in this space. That's it, right? Because, most of the time when you invest, you're investing in but just have a seat anywhere you like. It's fine. Most of the time when you're investing, early stage, there's not much there yet. And so you got to count on the people around the table being able to step it up. So the most important thing on these slides is put something in there that helps us understand why you're in the business, or why we want to invest in you, or what your relevant experience is. And then, to make everybody else in the room feel happy, talk about the team. Who's on the team, what the focus is on the team. We have 4 software engineers and 2 app developers. So on a very early stage tech team, we want to see mostly people who are helping build the product. That's it, right? So if you've got 6 admin people and 4 people in your finance department, all that other type of stuff, don't put that in the slide because that's not going to make us feel any better. Just leave that off. but we want to understand who we're investing in, and when we write the check, and people have to make decisions on a day-to-day basis about where to spend money, what customers to focus on, how to prioritize. That's what we're focused on. And I will tell you, a great team, almost any deal, and you guys can disagree with me, we get any deal, any opportunity sent to us from a great team, we're taking the meeting. We are always taking the meeting. Whether it's an area that we know about or not, we're doing it.
So the next slide is the product slide. There's a consistent theme here with that slides. Overly wordy, I mean, putting things down, like hyper-contextual calendar at sales tools, it's just way too wordy. You can't see the product, you don't know what it is or how people use it. A good product slide which we have, we'll show that, like this right here. So you kind of see the product, you know, feel for how it works. It's a clean slide, it's digestible. I hear that like every day at ours, it's gotta be digestible. Jason, any more on product slide?
No, and I would say, you know, when you're pitching this, right, this is one of those opportunities for you to figure out if the person you're pitching to has any idea what you're talking about, right? Sometimes they will not have any idea what you're talking about. So these are some important slides. Keep it simple, and then if people who are really into this market want to start asking you questions about your product, or your product viewpoint, or where you're taking the product next, or what are additional product add-ons, they can always ask those questions, right? And there are questions you should obviously be able to answer. But you don't have to fill everything in on one slide because there's just no way to possibly digest it.
So next, bad market slide. So market slide's a pretty important slide. It helps us try to get a feel for what that market looks like, how big it is. And basically this slide saying it's targeting every single person on Earth, which isn't reality. So this is kind of a cleaner look at a market slide.
And I think what's really, really critically important to us when we look at these market slides is, so what we're trying to figure out on these market slides is a few things. Number one, we're trying to figure out how big the company can be. So if you're targeting a $30 million market, it can't be that big of a company, right? You get 100% of the market, it's a $30 million company. So we're trying to get a feel for how big is the market, how big is the opportunity. We're also trying to get a feel for, do you understand the difference between the gross market is $2 billion, but I have a product that can address 400 million of it. And so that mindset's got to come out in one of these slides, which is, and you'll see some more of this in the future, which is, hey, big market, growing market. A lot of times we see, you know, slides with growth curves and those types of things. This has got to be something that shows that you understand the market you're going after, you understand the value you're providing in the market, and you have a realistic understanding of what part of the market you can actually address with your product.
So back to that slide here. So Jason was talking about understanding the market. A big part of that for us will be understanding how you're going to that market. We kind of like to see targeted, focused approaches, and this slide is kind of the opposite of that. And again, similar themes. If we can't read the slides, if it's hard to digest, we're just not going to be able to follow what you're doing. So this is kind of an example of a good bit of marketing.
And by the way, these are not meant to be the prettiest slides you've ever seen, but have the right content. So you know, we will always ask questions about how many sales guys you have or gals you have, how many customers you're going to have as you grow, what's your average sale per customer, all those types of things that you should already be thinking about, right, if you're trying to build a business. But this go-to-market slide also helps us understand, number one, how are you thinking about scaling the business in terms of, am I going to target a niche part of the market? Am I going to target a small piece? Am I going to have somebody else sell my product for me? Am I going to, you know, so it gets sold indirectly into a channel? Or am I going to sell it directly and build up a large sales force? Who am I going to partner with? It also allows you to spend some time talking about traction you have already got. So the best slides we see here is, hey, we're going to go to market, and we're going to go through financial institutions and consulting agencies. And by the way, the ones that are grayed out, we already have a pilot going, and we've got 1,000 people using and demoing the product, blah, blah, blah. And that allows us to start asking questions about what's your feedback been, what's the timing look like, how did you get into these customers. But these types of slides on market and your go-to-market strategy are really, really important to us because they tell us a lot about how you think about the business and growing the business. And the more you know about that, and the more you've thought that out, the more likely you are to be able to take $1 million from us and turn it into a real business.
So I heard Alan Kupets, who most of you probably know here, give a presentation about 2 weeks ago, and somebody asked him, what's the most annoying thing that you hear in a pitch? And this was his answer: no competition. The reality is there's always competition, whether direct or indirect, and we will understand. If we don't know, we want to know that you know them, so you can tell us about it.
Yeah, well, I can't tell you how many times we get, nah, there's no way to compete with us. Blah, blah, blah. Is it the first one or is it the one before?
No, so this is the next one.
Oh, it is.
This is the bad one.
That's about right. That's good. So there's a couple ways to hope we can do a little graph thing. There's a couple ways that we look at these things, but you got to share competition with us, right? So there will be competition, and oftentimes when you see the bottom one here, all of these sort of paper calendars, whatever. There's always some competition out there, and so really understanding what they're doing, not just from a product perspective, but how they're going to market, or what their growth looks like, or what their pricing looks like, or what their feature set looks like, are really, really important to us. Not because we have to be going after a market where there's no competition, because generally speaking, markets where there's little competition tells me that it's not an attractive market. But because it tells us how you think about your product, your customer, what those customers want. A lot of times folks will say, hey, we've rolled this out to 1,000 people. We've gotten feedback from 800 of them. Here are the aspects of the product they like. Here's the aspects of the products they don't like. And that type of information will drive all types of things like your product roadmap, your pricing, by the way, even your model. So, there are a lot of guys that are going out today with the freemium model where they're throwing out something that's relatively free, modest set of features, with the hope that someone will pay for more features and more functionality. And people have made some pretty darn good money doing that in the past. But this really helps us understand, what do you really know about the market you're going into? And if you have one of these weak slide here, it tells us you probably have to spend some time.
So the next slide is a financial slide. So these are typically at the end of presentations that we see. There's a couple reasons why this slide is bad. Do you know any company that's done $400 million in revenue in 4 years?
I don't.
So the financials just aren't realistic at all, for one. And two, the revenue model and the expenses just doesn't give you a lot of detail in terms of what's driving revenue or what's driving expenses. And there's a couple things that we'd like to see as it relates to that slide, which we've highlighted here.
So we don't need to have in this first deck your full set of financials and how much you're paying the finance department and how much you're paying in marketing and what you're doing. What we really want to understand is, what does the growth of the company look like? And have you thought about, what does your revenue look like? What is your margin, which means, what's the incremental dollar you're making when you upcharge? What are you thinking about in terms of OpEx, meaning everything else that's not in that margin line? And then cash burn, cash balance, right? Because the cash you got on the balance sheet is the fuel you have to grow the company. We don't have expectations, by the way, that you turn EBITDA positive in a year or any of that type of stuff. It depends completely on the company. But we always ask people about head count and customer count. And not everybody does this, but those types of numbers, very specific numbers, tell us what you are thinking about how you're growing both your company to attract new customers, but also how much are you charging the average customer. And it's amazing how many times we delve into this slide and figure out that someone has actually not done a very detailed financial model about what their business looks like. Nothing scares us more than someone going, well, we think we can get to like $4 million, and well, what does that mean? How many customers do you have at the beginning of the year? How many customers do you have at the end of the year? What does that growth look like? What's the average revenue per customer that you have, right? How are you attracting those customers? How are they segmented out? How many enterprises are those customers in? What's the average price per enterprise? Are you charging a license fee, or is it a recurring revenue fee? All those types of things. You really got to know how a real business runs in this, and you've got to present this to us. And these might not be the right things to present in every single business, because in some they're not. But you've got to be able to show us that you know how a financial model in this business works. And then help us, when you look at it, by giving us a couple of the assumptions that are in the model. Because we see this all the time, and we get no assumptions, no nothing. And then give us some conclusions that we should draw from the model that we might want to talk about. So, hey, it's a really, really capital efficient model. And then we can talk about why it's capital efficient and how much capital you need, and you know, how much incremental capital you need. You know, decreasing customer acquisition costs over time. Hey, we believe the network effect's going to work X and Y and Z way, and we're going to be able to, you know, it's going to cost us $10 a user to acquire the first 500,000 users, but that decreases over time, whatever it is. And then, you know, things like higher revenue per user over time. So we have one base product, we're charging $10 a user, but we're coming out with product 2 and 3 that layers on. And so for every user we have that's addicted to our product and can't get away from using our special, you know, e-calendar, we're going to be able to charge another $3 and then another $5 because we're going to give them a new notification tool or whatever. All those attributes of the company are really important for us to understand. And, you know, it's important for you to understand as well.
So we're kind of getting to the end here. So the summary slide is an opportunity to kind of summarize the key things that you want us to remember. So getting into things like what the free money valuation is or what the transaction looks like, it's just not really appropriate. It's not something we're ready to talk about. We're still trying to figure out why you're targeting 7 billion people on Earth. But so it's just not the way to go for the summary slide. This is what we feel is a little bit better.
Yeah. So just remind us what we should like about this business, right? That's the most important thing. Remind us what we should like about the business and why it should be something that we're interested in. You will never do a pitch, and we will not pull out the checkbook at the end of the pitch. That never happens. It never happens, so don't even go there, right? Remind us how much you want to raise, maybe, but really talk about why the product is so great and why the team is excited about doing it and what great market, and talk about looking for an investor to help build the company and that type of stuff. I can't tell you how many times we get these pitches and people go, oh yeah, we're raising X at a Y valuation, or we're doing blah, blah, blah. And the answer is you're not raising X at a Y valuation until someone tells you they're willing to give you X at a Y valuation. That's just the way life works, right? And so for most institutional folks, it's a high enough hurdle for us to actually want to invest in a company, because we see, I don't know, how many we see last year? 3,000 companies? Probably in 2014, we'll probably see 3,000 companies. So it's a high enough hurdle to get us to be super excited about, see a business and say, hey, I want to invest in that business. Don't start on the pricing yet. Just get us really excited about the business, and the next step will be pricing and all those other types of things. Don't get into the types of transactions, whatever. We will always, by the way, if we like a deal or whatever, we'll always ask you, hey, so I've raised $1 million, what do you think the right valuation is? Or whatever. We will almost always ask you that question. It is always a trick question. Every time you get it, it's a trick question. And the only good answer is, hey, you know what? We're excited about getting some additional capital in here to help grow this company, and you know the valuation will be whatever the market bears. Just leave it at that. That's the right answer. That's the right answer. We see this all the time. People go, well, we were thinking about, we might ask you some other questions. What was the last round raised at? Whatever. But don't fall for what do you think the right valuation number is? Because there's no right answer. If you give us a low number, it's not the right answer either, right? So just focus on getting us really excited about it.
That's pretty much all we had. No more bad slides or good slides. Jake, we're happy to answer questions or talk to you afterward. Most of the firm is here. We'll half maybe.
Yeah.
Paul, Charlie, CK, myself, and Jason. Any questions you guys have? Or hey, thanks for having us.
Did I cover good things? Go ahead.
I have a question. So, have you guys ever worked with non-tech companies and you mind sharing some stories about things?
So describe me non-tech company.
I mean, like, let's say a hummus company.
Hummus company. So, you know, so we actually have. So we've worked with companies. We worked with companies. We have an ice cream company, basically, that makes nutritional ice cream. So we have. I'll tell you, most of these principles sort of apply equally, which is the most important thing is if you got a hummus company and it's great hummus, get me excited about that business somehow. Get me right. And the truth is, as you're talking with angels or whoever it is, the most important thing is to get someone on your team. Even if they're writing a check, they're on your team, to be really excited about the business. And to see the opportunity the way that you see opportunity. And hopefully those people can add value in a way that's complementary to what you're doing. So they have, in that business, they have a business, they know how to get into the right distribution channels. Or they have connectivity in the right retail outlets, or whatever it is. That's the most important thing.
Jason, I have, in representing a lot of tech companies, a lot of times I would tell a client, the founder will be, doesn't speak English very well. I usually try to get someone who can actually knows the company and speak English well for the research. What's your guys' view on having someone who might be the founder but not really
So that, by the way, I would tell you the worst, I think we want the person who's the most passionate about the business to present the business to us. And if they understand the business and that, then we can get through around all that stuff. I will tell you a bad thing is, we've had guys who didn't know how to raise capital and they brought in an agent to help them raise the money. And then that guy tries to pitch the business and he's read the slide deck and he's maybe written a business plan, but he or she doesn't know the business. And there's nothing worse for us than to sit down with somebody to talk about a business and get, I don't know. So I mean, in your instance, I would say, you make sure it's a good pitch. And if there's communication issues, you come, right? Because we're not, if we think it's a great business, we're not gonna not do it because of that reason, right? And if the answer is, hey, we've got to help them build out a team, or we've got to help build out a team that that addresses certain customer sets in a better way or a more efficient way, we'll do that.
You mentioned that you're generally the first round of institutional equity, so the angels have already invested?
Or no one has invested.
Okay. So what general metric do you use is where, if there already has been a first round, where does a company get to the scale where they're ready to talk to you? Is it a revenue hurdle, or is it some sort of, they have a model that works already, it's actually in a small scale and you can...
We get asked that all the time, so, we've written $250,000 checks with 5 other venture guys. There's been no product yet, and that first $1 million was used to develop a product and see if people like it. So we'll invest really early sometimes, and in some businesses we'll invest much later. So we don't really have a rule in that. I would tell you, we're much more willing to take very early risk with a team that has done it before. So if you've never run a business, or you've never run a business in the space, or you've never done any of those things, and you are really early, the likelihood of us funding you is not very good. Right. So getting a little bit of capital and starting to ramp that up is probably the best way to do it. But I will say this: we work with a bunch of angels here in South Florida and all over the U.S. and we like to see stuff pretty early. And we have often sat down with the company and said, hey, it's pretty interesting. It's going to be way too early for us. And we're pretty candid, right? Since you, Mr. Entrepreneur, are not a proven team, we're not going to make the bet. But if you can get someone to make a bet, these are the 3 things we'd like to see you accomplish before we're ready to take some risk. And we're generally pretty open about that. Our business is a risk return business, so, and most outcomes are binary.
So kind of feeding off that, you're mentioning that, the team's important and their history is important. If someone doesn't have that history, the team doesn't, would you say getting people with history on the board of directors, or how can someone overcome that?
Or an advisor, or by the way, we seeded a company, Paul seeded a company, and the guys are doing women's fashion e-commerce in a new type of model, and they don't have that in their background. And we seeded them with a number of other people, and they have kicked ass. And so we're writing a bigger check, and lots of people around the table are writing a bigger check, right? And so I think to a certain extent, it's about executing. So if you don't have those people around, you got to figure out how to execute. My recommendation would be to get as many people around you that can help you execute, whether they're on the board of directors, whether they're on an advisory board, whether they're part of your team, to help you execute really early on, knowing how to go to customers and all those types of things. The one thing you brought up here is, people ask this all the time, well, should I get so-and-so on my board of directors? So, and Terry can talk about this, is a legal issue. Board of directors is, if you don't know that much about it, that's a governance and corporate governance board. That means that it's somebody who sits on your board and has to vote on things, and you have to present to them, and it's a governance function. It's not a helping you build your company function. That's not what someone on the board of directors is. They may also do that, and we tend to spend a lot of time doing that. But when I'm on the board of a company, it doesn't just mean that I do that. It means that I do that, and Charlie does that, and Casey and CK and Paul. We all do that with our portfolio companies. But having someone join your board of directors is really a corporate governance function. So you have to decide if that's the role you want someone in that industry to take on. If they're writing a small check, they might want to. Or whether or not you should get an advisory board or a strategic advisory board of people who you actually work with to help you execute on that company. Because a bunch of fancy names on a board of directors, believe me, if I call them up and I go, wow, this is really impressive, Joe Schmo's on the board of this thing, and I call him up and he goes, oh yeah, I love that guy. No, I think this is really interesting what they're doing. That means he's not engaged, he's not spending a lot of time, he's not sitting with company. I just think it's really interesting, and he's a nice kid, and whatever. Then doesn't help you guys that much in that. But I would say if you don't have an experienced team, get as much experience around the table as you can to help execute well.
When we're talking about you making bets on companies, wouldn't it a better bet for someone with a concept to go to whether it's a higher density of venture capitalists like Silicon Valley?
Yeah, believe me, you're more likely to raise venture capital in Silicon Valley than you are here, right? Because I think you have the largest number of venture capital, other than outside my office, this is the largest number of venture capitalists gathered anywhere in Central Florida right now. By 2x probably. 5 of us in here, right? So yes, the ecosystem in somewhere like Silicon Valley, or somewhere like Boston, or somewhere like DC is remarkably different than it is here. Absolutely. But I will tell you, none of the things on my slide are any different there. And the notion I'll tell you is if you don't have this down and you go out to the Valley, I can guarantee you're not getting any money. That I can guarantee.
Kind of going off that point, I've heard other people tell me, rather than the fact that it's easier, that they can also, and I don't know if they're just blowing smoke or whatnot, can get better valuations outside of this market. Does location matter in terms of what kind of valuation you get?
It absolutely does. It absolutely does. So the valuations in the Valley are sort of crazy right now, to be honest with you. So same deal. It's got to be a good deal or it's not going to get funded. So don't, you can't do outliers. But yeah, the valuation of the same deal that's sitting in Michigan versus one in California is, it's different, right? It'll be higher in California. The terms will be slightly different. There have always been different terms on the West Coast and the East Coast. That's always occurred, right? So East Coast-ish are a little bit more financially structured than West Coast is, but but that's definitely true. The difference there is let me tell you, I can go find, I mean, I'll give you an example. If I got a IT security deal here, it's harder for me to find a great team to build that company here than in the Valley. I can think off the top of my head 3 really great CEOs for an IT security company that I know are sitting on the beach in the Valley right now. And I can't actually pick one since Central Florida, but I'm sure there are here. But it's just a different ecosystem. It's just a different ecosystem. But at the end of the day, valuation doesn't, the outcomes are binary. I said that, and what I mean by that is there's no value investing in venture. So there's no, hey, I got these two deals, but this one's a pre-money is 12 and this one's a pre-money of 10, so I should go to the 10 because I'm getting a better deal as an investor. That doesn't exist, right? You want to invest in the best deal with the best team and the best market and the best whatever, and those are hard to overlap. And the likelihood, if you look at mode outcome, is both of these deals, I'm going to lose all my money in both of them. All my money, not some of my money. I'm going to lose all my money in both of them. So the important thing is to find the deal that's going to go, that's going to be a 10x deal. And it's not very many of them. And so whether I pay a 10 million pre-money or a 12 million pre-money doesn't really matter. It's about finding that deal, and everything else is around the edges.
Have you guys ever invested in a company so that company can buy another business, maybe a competitor that is lacking something, or a team? Or...
Yeah, I mean, we've had lots of our companies that we've invested in buy other businesses or roll stuff up or acquire critical component of technology and that type of stuff. The key is that the base business has to be worth investing. The base business is not worth investing in. We don't want to make it bigger.
Deck didn't have hook and planned exit, which I kind of expected. Any reasons?
Didn't have
Hook and the hook entry, the hook, the tees, whatever on the front end, and the planned exit.
So the hook was meant to be sort of the intro. Hey, we're addressing a blah, blah, blah. We see so many slides with exits in them. I guarantee my team will know more about exits and multiples at exits and whatever than anybody running their own single company. Because we see 3,000 of them, and we track every exit out of the venture world. So our objective when we invest, like many entrepreneurs, is to exit. So, I mean, we're not, it's just the way it is, right? So you could throw that in there if you wanted to. It is usually a point, so if you did it and said, hey, we're in this space, and look how many exits there are in this space consistently happening, that's a good way to do it. If you do it and go look at these exits and look at the multiples of those exits, start thinking about a really high valuation, don't do it. Because it's helpful to us to know that there are lots of exits in the space. It's not helpful for people to start going, hey, the average exit of an enterprise SaaS deal, the average valuation of an enterprise SaaS deal is 10 times sales, and I'm at 1 million of sales, so I think I should be at $10 million. That's a bad discussion to start having in the first meeting. But if there are lots of exits, and we get this with IT security a lot, there are lots of exits in that space, so it makes us feel like, hey, I mean, we already know that space, but if we didn't, it'd be something to add, right? Hey, there's, company a week getting acquired by some of these big players with cash and stock and all that type of stuff.
So kind of following up on that point about exits, isn't the financial projections and that also kind of, you're taking a guess at what's going to happen? Because, you're a young company, you're going to pivot, there's going to be different pricing models, things can change. How locked down does that have to be?
So I will say this, in our best deals and our worst deals, those financials never turn out. Whatever we got pitched the first time, didn't get turned out. What it actually helps us understand is how you think about the business. So how fast can I ramp the business? Where am I spending money? How many customers am I getting? what do I think is a realistic expectation of X, Y, Z? When I'm asking you for $1 million, how long does that last? Right, in terms of burn and head count and all those types of things. So we know those are not going to be the actual financials, but it helps us really understand about how you think about that company's scales and all those other types. And it helps us see if you know that much about your other competitors, right? You're only spending, 10% of your revenue to get sales, and everybody else in your market spends 35%. That tells us that either you got to be doing something very different than them, or you haven't spent a lot of time thinking about who the competitors are and how that business really grows.
And so, I'm sure Arsenal is an exception to this, but a lot of venture capital firms, from what I've seen, fall victim to a lot of the greater market investors. That is that they chase the lottery ticket and the dream. Quoting from As With the Mataran, I'm thinking back to 2007, 5-year returns trailed the general stock market returns with considerably greater risk. And price is not part of your process, you said. So for your investment process, how do you mitigate risk when investing in companies? I mean, you mentioned the team's very valuable. How do they think about competition? Like, how would
team market,
yeah,
team market, understanding the technology. So there's a remarkable difference in venture capital than the general market.
correct.
And if you think about the general market, think of your bond fund and think of your top quartile bond fund and your bottom quartile bond fund, and think about how different those returns are. They're actually not that different, right? Point and a half. Let's say large cap equity, right? You could be, 1 percentage point better than the median or 2 percentage points better than the median, and you're a top quartile, top decile performer, right? Venture doesn't work that way. The bottom quartile of funds in venture are horrible. You're not getting all your money back. It's, right? The top quartile are killing it, right? They're killing it. They're doing great returns. They're doing way better than the market risk adjusted. And so it's just a remarkably different asset class than anything else, which is why, by the way, individuals shouldn't be invested in, right? Our investors in the fund are all institutions, right? State pensions, and they allocate 3% of the $50 billion they manage to this asset class. So it's a remarkably different asset class. We are always chasing a really big deal. That's sort of the nature of the beast. And the reason we are is because you can't invest in doubles and make a good return on your fund, because you're going to be wrong on doubles as much as you are on home runs. And that's just a statistically proven fact. So we have to be investing in something that we believe can grow very, very quickly. We don't know it's going to grow very, very quickly, but it at least has to have the opportunity to grow very, very quickly, very capital efficiently, in a really meaningful way. With the knowledge that we will be wrong, right? And at our fund, we've had better history than most at losing all our money, right? So we've had less donuts than the average firm. And so that's helped improve our returns, but all our returns are based on the best deals in our portfolio. There's an old saying that venture guys never like me to say, which is, and nobody ever thinks about, is the key to having a great venture fund is putting more money in your winners and less money in your losers. And that sounds sort of self-evident, right? Except you don't know who your winners or losers are right up front. And you don't know after your second round. And that's the trick to the business.
When you initially pitched, are there any implicit legal protections that would prevent venture cap firms from taking that idea and dropping it out to like an incubator or somebody else?
I don't know, because I'm not an attorney, but I will tell you there are no protections.
Okay.
But our business is not doing that, right? Our business is investing in somebody else running a company, right? So if you don't think that we're worthy of sharing your idea without an NDA or whatever, I won't pitch us.
But would you feel like at that point you need a lawyer before you're ready to pitch the venture cap, or do you think you're pretty safe at that point?
We don't start, we can't operate that way, right? Venture guys can't really operate that. Otherwise, no one's ever going to pitch us another deal, right? We get asked to sign NDAs all the time, and we tell people no, and they go, oh, I got this best thing, I'm doing this IT security thing, and I go, well, I gotta be honest with you, I only see 250 IT security deals a year. So I'm going to tell you whether or not I think it's unique or not, and even if it is, we just can't be under NDA to hear about the opportunity. If we say, hey, you know what, we really want to dive deep in X or Y or Z, we'll eventually sign an NDA, and if we invest, obviously we're signing NDAs, we have fiduciary responsibilities and that type of stuff. But right out the gate, you sort of have to say, hey, is this something I'm willing, is this baked enough for me to go out and say I want to do it? I don't know.
Because you guys have invested in some early stage companies that are like pre-product, pre-revenue, there's a lot of buzz right now about the lean startup methodology and actually going out to potential customers and learning about what they're willing to pay for and things like that. I know a lot of what you guys do on the investment side is kind of looking what's going on in the industry as a whole, and is the market look attractive, but how much of that would you like to see in a pitch deck about potential customers that you've actually talked to?
That'd be great, and I will tell you that we talked with the deal I did in June, right, which was a big name deal. I talked with 5 customers. So we do that work. So I know the lean startup is like sort of the new thing where you're going out and actually talking. Venture guys have always done that, right? I go talk with customers, potential customers, people I think might be customers, competitors. We pick up the phone and call all of them, right? That's part of our process. It's always helpful when the company has already done that,
right?
Because they can tell us what people think and what people's mindsets are, and they can tell us about weaknesses in their own pitch. Meaning, people like this idea, but I will tell you, you may talk with some customers that think it is too far departure from the way we deploy technology today, or to whatever. Sharing that with us is a fair thing to do because we're going to figure it out anyway. And it's only going to make the deal better. And I'll tell you, I can't tell you how many times, it doesn't happen all the time, but how many times people go, oh, we're going to sell it for X, Y, Z, and we do these customer calls, and people are like, yeah, I'm paying about 1/10 of that, right? And that happens all the time. And you can go to 6 customers, and they all say they're going to pay a lot less. The one we did, that I described, we had 2 customer calls where the guy said, I would pay 3 times as much as what they're telling me they're going to charge. Because I can do this and do this and do this. That is a good sign, right? That's a good sign of the value the company's providing.
So if you're among tech-savvy people, pretty wide variety of expertise, what space do you think in the future looks good to start looking at yourselves? Instead of coming up with something in your own head right away, what space do you think you could be looking at, one could be looking at, if you know how to do stuff?
So I think it depends on what stuff you know how to do.
Well, programming.
Programming. So, so we spent a lot of time on an enterprise IT, looking at efficiencies in small to medium-sized companies. So, but most of the time, those types of startups are best started by somebody who has expertise in that domain. So they're an ex-marketing person, right? And is looking at the emergence of social media and saying, hey, it'd be a great software that does X, Y, and Z. And the secret sauce is not the software at all. It's the knowledge of how that market's going to evolve. So in many of the areas that we're focused on, it's all about some type of expertise in a business that then translates into a product that happens to be software. So commerce and logistics, everything we're doing in that space is all about a different business model. It's enabled by software, but it's not, we're not inventing, new paradigm in those types of things. I do think that we have spent a lot of time looking at the emergence of the cloud, the emergence of the globalization of commerce, and being able to siphon off user data, customer data, site data, all those types of things is really, really valuable. Because people are trying to get more bang for their bucks in terms of advertising, in terms of logistics management, in terms of product segmenting. And so we have spent a lot of time on understanding how consumers are interacting, how companies are interacting with each other, and seeing if we can leverage some of those things for a piece of the margin. So I wish I could tell you, hey, focus on, I mean, I could tell you, focus on IT security because it's a huge issue now and it's only getting bigger. But there are a lot of people doing that. I mean, there are a lot of people focused on IT security space. But it's a really big problem.
We have time for one more question, guys.
Quick question. What's the average size check that you guys write? This is a supposition. If you like the idea, you want to get in this company, what's the average check that you write?
So it depends completely on the deal. So we don't really have an average check size, but in the seed stage, we'll write, anything from 100K to 250, 300, maybe 350. We did one that was 350, right? And then Series A is anywhere sort of between 1 and 3 million. And then we look to, most deals, we look to not have to invest more than sort of 5 to 6 million bucks.
Right. So can I just follow up with a thought on that?
Yeah.
So Guy Kawasaki said that, this is something that I heard when I was listening to one of his lectures. He said that if you take a look at your total fund, what your total value of your fund is, most at 20 or 30 companies, you divide by 20 or 30, that's probably a good average size on average that you would invest in that company. Is that a good
yeah, so it depends, and I don't know the timing of Guy's lecture, but there's a little bit of a trend going on in the venture space, and I'm not sure if it's a long-term trend or a short-term trend. I happen to think it's a long-term trend, but that those of us who are what I'll call early to mid-stage investors are more willing to do seed deals now, a lot more willing to do them than they ever have been. And a lot of people think, oh, it's the hype, it's the this, it's the that. What I happen to think is that you can do a hell of a lot more with $1 million in a company today than you could 10 years ago. And believe me, I was sitting in Central Florida 10 years ago. You couldn't do anything for $1 million. That's Martin Suter sitting in the back there. You could hire like 2 dev guys and a couple sales guys. There's no product. Now, with $1 million, we throw in 250. Our buddies in Andreessen throw in 250. You can figure out if you've got a really good product. You can figure out almost how your product scales. You can get a whole bunch of metrics on how much more capital you get. There's a lot of things going on in the market today. Not in every market, but in a lot of markets that allow you to get really far down the road with $1 million.
I agree.
Right, and so I wouldn't just necessarily say, hey, divide it by 20 or 30 or whatever. But when you go meet with a venture firm, ask them what their average check. I mean, you should ask them what their average check size is. And you'll go pitch them and say, hey, we're looking for $1 million to do whatever. Believe me, I'm going to make my own decision about how much money I think you need. So everything you put on the slide is sort of a starting point for us. But I might say, hey, I think you need $2 million, or I think you should take $500,000 and try to do these 2 things, right? Or you should take a little bit more. Sometimes that's because you can do more milestones. Sometimes it's because I want somebody else with a little skin in the game alongside me, right? And we're big believers that having more people around the table in terms of funding sources it really reduces the risk for the people around the table and it reduces the risk for the founders. And the example I'll use is the last few seeds we've done, we did it, Google did it, somebody else did it or whatever. And when the Series A came around, maybe there was room for one other new person to come in. But everyone around the table had set up milestones. They knew where we wanted the company to be. And everyone was willing to write another check. And you don't really get that with angels because they'll write a $250,000 check and you don't know how much they reserve. But you know that when I write a $250,000 check, I'm reserving anywhere between $2.5 and $3.5, maybe sometimes up to $4 million for follow-on financings. That's my business. I have a fund to do that, right? And so being able to get a few of those people around the table and interested is always going to be a benefit. It's always going to be a benefit to you.
Thank you.